Hi, everyone. Welcome to AC Always Connected, Managing Your Finances During COVID-19. My name is Michelle, and I'm the Events Officer with Algonquin College at the AC Hub. And today we're joined by Chris Coulas, who will be leading this presentation on managing your finances. So AC Always Connected is a new online event series that keeps our entire college community connected. Before we get started, we're just going to share a couple of housekeeping items. We kindly ask that you please stay on mute for the duration of the presentation, but we welcome you to please turn on your camera. Along the bottom of your screen, you'll see a button. It's called Participants. When you select this, a pop-up tab will come to your right, and please feel free to use this throughout the presentation. If you have any questions, we won't be taking questions until the end, but if something comes to you, just feel free to type it in the chat button and we'll come back to that later on after the presentation. And now to kick off the event, I'd like everyone to open up the Participants tab, and I'm going to ask a question, but don't answer the question until everyone's had a couple of minutes or a couple of seconds to type out your answer. So I'll just get everyone to open up the Participants tab, and the question is, don't press send. It's, what would you buy if you won the lottery? It's the first thing you would buy. So you can type out. Now I'm going to give everyone 5 seconds. I'll count down. And then at the same time, we're going to press send. Okay, so 5, 4, 3, 2, 1, go. Awesome. A vacation in Europe. I wish, I know. Great, thank you so much. So yeah, please feel free to continue to use the chat as we go through the presentation. So now I'm so pleased to welcome Chris, who is Algonquin's very own business administration alumni and now is an RBC investment and retirement planner, to please take the stage and share his expertise on managing finances. Chris?
Okay, right on. Thank you for the introduction. My name is Chris Coulas. I'm an investment retirement planner with Royal Bank. I'm, as mentioned, I'm an Algonquin alumni. I studied finance through Algonquin. I received my CFP, my Certified Financial Planner designation through Algonquin, along with my Canadian Securities course. That was almost 15 years ago now. I've had an extremely successful career after leaving Algonquin, and I want to do everything that I can to give back. I feel that I owe a significant amount of that to the people and professors of Algonquin, and I want to give back as much as I can. It's kind of interesting times right now. I've done many seminars in person. This is my first doing virtually anyway, so bear with me here. This is certainly something new for myself and for all of us. Obviously, there's a lot going on with COVID-19 and some unrest going on in the US and elsewhere, but we make do the best we can. A bit of background on me as well. So I started working with, after graduating Algonquin, I started with in 2006. Worked as an advisor with TD Bank all the way till 2014, and then as a financial planner with Royal Bank since then, from 2014 until now 2020. I have my Certified Financial Planner designation earned through Algonquin, and also Chartered Investment Manager, my CIM designation, earned after that. I know quite a bit about what I'm speaking about, to say the least. My role when it comes to investments within Royal Bank is I typically help higher value clients. I get involved when our advisors are speaking with someone who is a higher value client. They'll typically get me involved with more complex matters as far as investment and financial planning is concerned. I also do a lot of estate planning and dealing with when people die or want to plan out their estate. So that's kind of my day in a nutshell. Fully working remotely at this point. As far as that lottery question, you kind of caught me a little off guard with that one. Myself, if I won the lottery, I've always considered this First of all, I don't really play the lottery. I bought maybe a handful of lottery tickets in my life. It's kind of a shot in the dark, and the likelihood of actually winning it are very little. I kind of laugh, if you took, I see people all the time buying lottery tickets at the Metro grocery store. And I see the same people over and over and over. And I've actually had a talk with the grocery clerks there, and I've asked them, and they've told me exactly that. It's typically the same people buying them over and over. And had they taken that money, that same amount of money, and done some of the things I'm going to discuss today, they wouldn't have to worry about winning the lottery. They would be fine. If I were to, quite frankly, I wouldn't want to win the lottery. I think the publicity and all that goes with that would probably ruin my life more so than making my life. Another thing, there's statistics about lottery winners. 3/4 of them go bankrupt within 5 years. And that's because they never typically learn to manage their finances. They never managed to learn their finances properly before that. I deal with a lot of inheritances. I've had many people inherit lots of money, particularly those in their 20s who have done so. They usually fall into that same category. They inherit a pile of money in their 20s and are broke by their 30s. It is what it is. So as far as what I would do, quite frankly, I'd probably give half of it away to various family members. I'd donate the other quarter of it to charities of my choice. And then the remainder, I would buy investments in real estate. And I don't know that it would change my life too much, quite frankly, but that's what I would do. As far as I want to ask my own question, what do you believe money is? This is one of the things I actually learned when I was in Algonquin. Money is energy. Money is a story of energy. It's almost like a battery. It enables you to do things. They say that money doesn't buy happiness, and this is likely true. However, I've seen over my years and years of doing this, of talking to people about money every day, not having money will certainly buy you unhappiness real fast. It's freedom. It allows you to do what you need to do and achieve some of your goals. And we're going to talk about that in a bit here. The concept of wealth is one that wealth is finite. There's only so much of it to go around. One of the reasons that is that everyone has their own slice of the pie, and my goal is to make your of it. Wealth is a very relative thing. So to some people, a person with very little, there are people living around the world with next to nothing. You guys, even being a student with very few dollars in your bank account, you may be considered very rich to them. However, I may be considered rich compared to you, and there are others who are considered rich compared to me. So being rich and being wealthy is all a matter of perspective. It's really who you're comparing or what you're comparing yourself to. That's kind of my take on that. Now we're going to talk about. I'd like to talk about a few things in here. So there is a pre-made presentation by Royal Bank about budgeting. I would like to talk about both budgeting and financial planning. I'm not going to get too deep into it, as I know that you guys are students and likely starting this journey. However, some of this financial planning stuff can actually last you the rest of your life. And if you do it now, and if you do it while you're young, you'll have a major head start above anyone else who's doing it later on. So budgeting 101. So we'll start with this here. So today we're going to talk about what a budget is, what money is. Again, we're going to talk about creating your own budget and how you can save money while you're actually in school. So a budget is a tool, as you see here. Basically what a budget is all about is trying to get a gauge on how much money is coming in, how much money is going out, where is it coming from, and where is it going to, okay? It really consists of, this is how much money I make, this is how much money I spend, this is what's left over. There are needs versus wants. I'm going to discuss this a little bit more in depth later on. One of the things I've learned over the years, that people who have financial difficulties or who have, say, I call it financial freedom, are very good at prioritizing and distinguishing what is something they need and what is something they want. So a need is, a need is basically the only needs we really have. we need food, we need a roof over our head, and we need 1 or 2 pairs of clothes. Anything else is something that we want. Okay, needs keep you alive, wants make you more comfortable. Okay, if you're able to handle that and get a grip on that, you'll find it's much easier to manage your finances later on. Okay, if you have a budget, if you're able to manage and you have more money coming in than going out, exactly what's on this slide, you'll have less stress, you'll be able to have a handle on what's going on in your life, prioritize, make smarter decisions, absolutely, stay focused and reach financial goals. I'm going to be talking more about goals later. One major step to achieving those goals is actually to write them down, okay? A goal without a plan is just a dream, is a saying, I believe it's by Warren Buffett, and I absolutely believe that. That's one of the things that I do in my day-to-day work is I help people basically put a price tag. What are your goals? What are they going to cost, and how are we going to get there? Those who are over budget typically have more stress. That's the problem with not having any kind of plan. You don't necessarily know where you are. You don't have a handle on your situation. Will typically overspend, buy things that they don't need, that they want, and that they don't need. And again, unnecessary expensive bank fees, all sorts of other fees, interest costs, and all sorts of different things. Okay, unnecessary debt will kill your financial plan very quickly. Okay, so where does your money come from? At this point in your life, being a student, you could either be working full or part-time. I used to work part-time, actually closer to full-time while I was attending Algonquin. There's all kinds of, the new gig economy. Uber seems to be Uber and Uber Eats. There's all types of different things that people are doing part-time and self-employed. You can get scholarships, grants, RESPs from your parents, student loans, and then earnings from investments. Now, I doubt that too many of you guys are earning money from your investments at this point in your life. But it's likely that the money that is, if any money is coming from your parents, particularly the RESPs, education plans, that they are coming from earnings. Also, I mean, selling things on Kijiji, that's a fairly limited option there. Birthday money and money from your parents, again, same thing there. Email money transfers, well, you've got to earn it somehow. Wire transfers and tax refunds. All of those are not necessarily sustainable, and they really depend on people giving you money. Thus, it's not necessarily sustainable on any long-term financial plan. Good while you're students, but once you're done, maybe not so good. Where does all my money go? That's a funny question. So they can go to all different types of things here. I mean, we have rent, tuition, books, food, coffees, Netflix, you name it. All sorts of different things. Where does it go? There's always, that's that wants versus needs. Typically when I do budgets with people, or when I used to do budgets with people, normally we would almost always have a surplus. When I go through those exercises with people, almost everyone is, if you just look at how much you're bringing in versus how much you're going out for rent or mortgage and groceries, most people have a surplus. I get the question all the time, why can't I save any money? Well, it's going to all this other stuff that oftentimes people think they need, they don't necessarily, and oftentimes it's a want versus a need. Now, where do you want your money to go? This again, this is all wants right here. Spring trip, girls' night out, Uber Eats, restaurants, gaming, haircuts, you name it. I'm kind of the recipient of a quarantine haircut right now. All sorts of things. New shoes. I mean, how many pairs of shoes do you actually need? Just one, really. One for summer, one for winter. Now, okay. So the first step of creating a budget and putting all this together is to track down, is to put on income. How much am I getting and where is it coming from? There's also expenses as well. Where is all of my money going to? And again, setting goals for your money, we'll get into this in a little bit here. Okay. So part of this is what we call cash flow, is how much money are you getting? When is it actually coming in? Is it come in once a month? Does it come in twice a month, every 2 weeks, the 15th and the 30th of the month? And same with expenses. You know, is your rent due on the 1st of the month? You have a mortgage on the 12th of the month, car payments, whatever have you. When is that coming? And if you can get a handle on this, this is the first step. Then you can put together an effective budget. So here's a budget. Here's an example of a budget tracker. RBC has tools like this. All banking, almost every bank nowadays does. If you look in your online banking, you'll typically be able to find some sort of budget and application for that. There's a lot of AI, artificial intelligence right now that the banks are using to find out, to basically get a handle on this. What are you bringing in and what are you spending? We're using it to, our goal is to help people to figure this sort of thing out, to become more effective and better savers with their money. A lot of people believe that banks are in the business of of basically taking money from people. That couldn't be further from the truth. We want strong clients. We don't want clients with financial troubles. We want strong clients because it makes us stronger as an institution. So what do I do if my bank balance is negative? Well, first of all, again, here's some of what's essential and what's not. This comes to needs versus rents, or needs versus want. Rent is essential. Tuition is essential. Books are essential. Hotels are certainly not. Restaurants are not. Transit is. So it's first of all identifying what is a good expense, what is not so good expense. Different ways to, so here's some ways to save money, okay? The easiest way to become wealthier is to save money. Spend your money smarter. Again, you show your student card. There's all sorts of Groupons. RBC has offers, likely your bank does too. There's some web pages for it. And as well, there's all sorts of different ways out there. One thing to note, especially when you're working, is that you're taxed on your money that you make. If you make $15 an hour and you want to pay $15 to buy whatever it is you're going to buy, it actually costs you more than that because you're paying taxes. You make significantly less than $15 an hour when you actually count for taxes. So the old saying, a penny saved is a penny earned, is not necessarily the case. A penny saved is closer to 1.3 pennies earned when you factor in taxes. Okay, buy secondhand. There's a big one. This is one of my favorites. Finding more money. There's several ways here. RBC, we're almost always hiring people in finance and people otherwise. Investors, any savings that you have, so your money makes money. This is my favorite here. This is what I do professionally and personally. And at this point in my life, I'm 38 years old. I make almost as much money from my savings and from my investments that I actually do at my job. Ask your parents. That's not necessary. I mean, that's a kind of a temporary answer. And talk to a financial advisor. And we're going to get into this here. Having an actual plan will help you be much, much more successful than those who don't. So a good budget. Having a slush fund, an emergency fund, okay? Absolutely, you should do this. An easy way to do this is to open a savings account online and then set up an automatic savings. This gets to how much money is coming in and how much money is going out. If you have a set amount of money or a certain amount of money coming in from work or from whatever have you, wherever it is, take away some of that and just put that away, put that into that savings account. There are several ways to do this as well. Both your easiest way is to do an automatic. If you have to pay rent on the first of the month, maybe the second of the month is a good day to put away maybe $50 a month or whatever you have into a savings account. This will ensure that you have funds for if you need for unplanned expenses, if you get a flat tire, something happens, COVID-19 is a perfect example. It's a bit more of an extreme example, but it's a perfect example. Okay, savings goal. So we're going to get into setting goals. You're going to later on. And if your income is bringing in less than you're spending, that's not sustainable for any long-term period of time. So you're not setting yourself up for success there. Okay, don't ghost your budget. I mean, that just stay within it if you can, absolutely. Don't abandon your budget either. Again, same type of thing, stay within it. As soon as it's very easy to start spending beyond your control. And don't ignore your budget. So this is some of the things here, this is a perfect example here. All you can eat, wings, favorite bands, etc. This sort of thing can get away on people pretty quickly. There are a lot of ways to track your budget. So all of online banking nowadays between Royal Bank and other banks have all different types of budget calculators. Here's one for RBC, but all of them will have that. So Excel is an easy one. You can set a quick Excel spreadsheet. There's apps, and then again, the Royal Bank calculator. There's also tools, so alerts within those calculators. There are alerts. So again, as I mentioned, we're using a lot of artificial intelligence, AI, to help with this sort of thing. There are all different types of alerts that you can set within your online banking with pretty much any institution nowadays. They'll tell you if you're spending too much on restaurants, or if you spent a lot that month. Know Me Insights. So this gets back to some of that artificial intelligence. Royal Bank and other banks, for that matter, we're all using artificial intelligence now to identify how can we save you money. So Know Me is a program through RBC that basically it analyzes your spending patterns. It sees what's going in and what's going out, and uses that to it basically uses that I guess to help you save money. It opens up a savings account and will help you save money here, and your online banking is all part of that. The ways to save. So number one is set the intention. What that is basically have a goal. Write down your goal. That's the number one biggest thing. That's 90% of having it and being successful is actually to write it down. Having a goal written down, I think you're 3 times or not more likely to actually achieve that goal. Automatic transfers. This is my favorite. An example of an automatic transfer is since the day I started my career with TD in 2006, I put away 10% of my salary automatically into first with TD, now with RBC and other savings plans. I have never missed that money. There's never been, I can maybe come up with a day or two in my entire life that I said, I wish I had that extra $100 or $200. Now that I'm 38 years old, more than 10 years later, I'm extremely glad I did that. It's don't have, and it's as simple as setting a date, saying the 15th of the month, I'm going to put $100 into this savings account. If you do that and it's automatic, it's going to happen, and your other spending will actually, you'll find out ways to save money. You'll spend around that. And again, this Know Me, Find, and Save. A quick other little bit on budgeting. Most people only really set a budget. The only time a lot of people are actively thinking about money, and I don't mean passively, just kind of complaining internally, wishing they had more, but actively making decisions about that money, is when you're looking at a pin pad, or when you're about to just about to buy something. Every time you're about to buy something, unconsciously, internally, you do a little automatic thinking there. And again, you're basically doing that same calculation. How much do I have in my account? When is my next paycheck? How much is my rent? When is my next rent payment or cell phone bill or whatever, and afford to buy what I'm about to buy? You do that automatically, whether you think about it or not. If you set up an automatic transfer, eventually what happens is that it just becomes part of that routine. A perfect example of this is rent, or a car loan, or a cell phone bill. Anything that comes up automatically, it's just deducted from that train of thought. And you may not realize it at the time, but because of that automatic savings, you may make a better decision. You know, I'm not going to buy this slice of pizza today because I know that my rent's coming out tomorrow, or that $50 I have going into a savings account is coming out tomorrow. It just becomes part of your financial routine. Oh, one moment here. I accidentally closed that. One moment. That didn't work out. Give me a moment here. Let me get back into, I accidentally closed instead of flipping to a new slide. That's part of this, unfortunately, part of working from home and some of these virtual seminars now. Give me just a moment to get back in here, of course. Yes, yes, yes. Okay. Okay, and one moment here. Just find out where we were. Okay. Okay.
Chris, do you see the share screen along the bottom?
Oh, one moment here. Start video. Okay, there is share screen. Here we go. Okay, here we go. Okay, can you see that?
Yes, thank you.
Perfect. Okay, so we are here for you. Just a very brief one. Any financial advisor and any banker, we're basically here to help sort this thing out, these sort of things, help you with this. Again, people who actually write down those goals are significantly, as studies show, it's off the charts how much more likely you are to actually achieve those goals. Okay? And that's basically what the job of a financial is. The vast majority, I've worked with hundreds of them over the years. I've mentored them, worked with them directly. I work with several financial planners that I help every day. We're basically, what we're here to do is our jobs are basically to try to make people more money, to try and make them wealthier and better off. Okay, and we do that actively every day. Okay, so first of all, and again, this is kind of some of the wrap up to the RBC slides. I have some more about some financial planning after as well. So here's some of the start, before you leave today, absolutely download some sort of budgeting tool, or at very least, at the very minimum, make a template, write it on a sheet of paper. Fill it in, actually look at what you're doing, and book an appointment to share this with an advisor. And they can help you fill in some of the gaps and also help you with what to do after. Okay, so here's some information about me. This is the end of the RBC generated slides. I have my own to discuss financial planning. I think it's very relevant. And this is actually going to, the first little bit, I'm going to get into how to save and actually have a significant amount of money later on. That's about dollars and cents. Now we're going to start talking about significant money later on. Actually, real quick, banking with a partner. This is something that over the years, I kind of came up with a system many years ago. This is makes it a little easier to bank with someone else. As an example, my wife and I have been together really since about 2006 or 2000, actually, well, before that. At one point, we moved in together, and we decided it was time to sort of join our finances. So there are two systems, two ways to do this here that are effective and work very well. The first system is joint but separate banking. And what that means is bank together but also bank apart from each other. It has to do, so first of all, I have my bank account, she has her bank account. Both of us have our paychecks going into our own separate bank account. We have our own expenses coming out of those bank accounts, and we also save money into RSPs or whatever have you, our own little emergency fund. We also have a joint bank account. Out of this joint bank account, all of our, at that point, our rent or mortgage, groceries, bills, anything that's a joint expense, a hydro bill, cable, our internet bills, all of that sort of thing will come out of this joint bank account. Our rent will come out of that joint bank account. Groceries come out of that joint bank account. How we do that is that when we have a debit machine, so with your bank card, we have it set so that our checking, when you push checking on a debit machine, that comes out of my single bank account, my own bank account. Okay, the checking, savings, and other buttons, we can assign those to any bank account that you have. It doesn't necessarily have to be a savings account that it's coming out of. So that's how that was how we originally did things. And in order to keep it simple, what we did at the time, we each transferred $600 a month automatically from our own account into that joint bank account. And that's what we used to pay those bills. Okay, that way it made it easy. Everything was equal between us. We had exactly the same amount going into the account, and all the bills coming out of there were basically joint expenses. We never had to bother each other for, you owe me $12 for groceries and you owe me $100 for rent. That's all taken care of here. The advantages to this system: everything is equal financially. Every bill is split 50-50. As I mentioned, we're not, trying to bother each other. Please send me $5 for groceries and $10 for gas. If we ever were to split up All we have to do is each of us take half of that bank account, close the account, and that's it. And again, we don't need to transfer money for groceries. It makes things simple. It maintains financial independence. The disadvantages, there's no transparency, okay? One spouse can be a spender, the other one can be a saver, and that does not account for that. Because we're each running up our own expenses individually, that can be a problem later on. It also does not treat both members as a financial team, okay? At the end of the day, where a couple work together, we need to act like it. No team is good if both members are acting independently. It may lead to issues in the future due to lack of transparency. And this is a big issue. Most couples over the years, I also deal with a lot of divorces. That's part of my job, is to get involved when people are divorcing, because it's a more complex financial matter. The amount of people that split up over finances, people split up for two reasons because of finances. Number one, because they don't have enough money, which again leads to a significant amount of stress. Number two, also is lack of transparency. I see this actually more often, where one is a spender and one is a saver, okay? And what that basically means is that one person is spending a whole lot, one may be spending willy-nilly, the other's a saver. This actually leads to a very difficult dynamic. One partner may also have a big difference in salary. This happens a lot too. That leads to one partner having very little discretionary income, the other having a whole lot. Okay, so this gets to the second system. Number two is joint banking with an allowance. Okay, this is the system that my wife and I currently use. We've been doing this for over 10 years now. We transitioned from the first system where we were kind of together to a full-on team. It's much more effective, better for saving money, and you'll see that in a moment. It's different. We start with our joint bank account. All of our money, our paychecks go into there. Automatically, our paychecks go into that. All of our bills and joint expenses both come out of that. Our mortgage, rent payments, groceries, all of our savings, whether it's money for my RSPs or her RSPs, all savings come out of here. We're married. What's hers is hers, and what's mine is hers as well. That's just the way of things. But all joking aside, everything is split 50-50. All of our travel, anything that we can basically consider a joint expense is kids. Any expenses for kids are coming out of that as well. Then what we have our own little bank accounts, in which what we do is that we transfer $100 every Friday into our own personal accounts. It happens automatically from my bank account. Any personal expenses, I mean, I work at the RBC at Center Point Drive, so I'm at College Square quite frequently. I'm always at the Pizza or Popeye. PlayStation 4 games, I'm kind of a nerd. My only want versus need, one thing that I like to splurge on, I wear suits, or I used to until a few months ago, 5 days a week. I save my money. I like to wear custom suits. It is what it is. I save my money accordingly. And I'm also saving for a PS5 actively. Now, my wife, again, she goes to a restaurant with her friends quite frequently. She's got a thing about shoes and sandals. She likes that. Frequent car washes. I find a car wash is useless. After a week, it's bound to have rained, and we're in the same boat. And she was saving for a Florida trip with her friends. That's kind of off the table anyways, due to COVID, due to some unrest that's going on. We'd rather just not travel to the States anytime soon. But the point is that if we are saving for ourselves, we're able to do that in this account. Okay, some of the advantages to this, my wife and I never fight about money. Okay, I can splurge and spend way too much money on a custom suit. She is not going to bother me one little bit about it, because I've saved my little allowance. You know, I've got $100 every week going into that account. If I want, I can spend 20 or 30 of it at Popeyes or wherever, and the remainder is saved for a suit. If it's important to me, I'll save for it. It may take several months, but I'll do it. And in that case, same with her. You know, she can buy all the car washes and restaurants and savings for Florida trip as she wants. I'm not going to bother her about it. I couldn't care financially, because she saved her own money to do it. If it's important to her, she'll actually save for it. Some of the advantages to this. Same thing right there. Every bill is split 50-50. We have full transparency. Again, I don't care what she winds up buying with her own account. That's her business. She has her own little money, and same with us. It accounts absolutely for differences in income. Back early in our careers, she made a lot more money than I did. Now that dynamic is kind of flipped a little bit, but it basically treats us both one way or another. No matter how much money we're making, we're both equal in each other's eyes. It also commits to a system that will increase savings. What I mean by that is I'm less likely to save willy-nilly. If it's something expensive that's a want and not a need, I'll save money for it. Instead of buying it today, I may, you know what, for that suit that I want to buy or a PS5 that's coming out in a few months, I'm going to have to save my money. I'm going to have to save my allowance. If it's important to me, I'll do that. If it's not so important, well, maybe I won't. And instead of me going out and buying it tomorrow, well, if it's that important, I'll wait a few months and I'll save for it. It will also, what that will also do is increase our ability to save money later on, to account for budgets and goal setting later on. And it's more like a financial marriage. Again, as I mentioned, we're a team. Disadvantages, sometimes we argue about what's considered a joint expense. That definitely comes up. And again, less independence. I can't just go and start buying everything willy-nilly, and neither can she. If we want it, we have to save for it, but that eliminates the ability for me to just go out and start blowing money left and right. A little bit more difficult if we ever split up because our finances are so tied together at this point. But again, as mentioned, we're married, we're in it for the long haul, we're not in it. Okay? So this gets into financial planning. This is much more long-term. Okay? It's a fluid process. We're human, lives change, people change. The world around us changes. Nothing is ever the same. Okay? Financial planning is basically a process, and this is what we help do for people here. Number one is to set goals. Number two is to prioritize goals. Number three is to quantify goals. And what that means, setting goals. What do I actually want to accomplish? Prioritizing them. Which goals are important and which are less important? Just because I have different goals, some of those are more important, some of those are less important. And again, how much is that goal actually going to cost me? And I'm going to give a real life example of this in a minute here. Each goal has three major variables, okay? So every goal has three things major associated with it. Number one is the cost. Number two is a time. Number three is a saving. So by cost, I mean, how much is that going to cost me? And again, as mentioned, I'm going to give examples of this. When do I want and when do I need this? How much, and savings. Number three, this is probably the most variable, and this is what we use for financial planning here. How much am I saving? How much do I already have saved for that goal? And how much am I actively saving? So a peek into Chris's life. So just to put a bit of background, I'm 38 years old. I'm married. I have two children. You may be able to hear them in the background right now. I have three different goals. Number one is bathroom renovations. So I'm I like to do renovations. I do most of them myself. We bought an older house and we're renovating room by room. So the next one on our list is a bathroom renovation. It's going to cost $5,000. We plan to do it in 1 year. In order to reach that $5,000 in a year, we already have $3,000 saved and $167 a month. Number two, kids' education. Okay, so here's another goal that I have. I want to provide for my children $5,000 a year for 4 years times 2 kids. Okay, this number here, everybody is different. Some people are willing to bankrupt themselves for education for their children. Some people are not. Okay, myself, the way that my wife and I were both went through Algonquin, we paid a big chunk of it ourselves. Our parents, for both of us, believed that we had to have some sort of skin in the game. We had to have some sort of something to keep us motivated. They believed if they gave us money that we would just basically blow it and not necessarily take our studies seriously. So coincidentally, our values are very similar for myself and my wife. I'm going to need that in 10 years from now. That money, my kid's going to be turning, well, he's 9 years old, so maybe about 9.5. And savings, well, I've got 20,000 saved, and I need $167 a month in order to achieve that goal. 3 is retirement. Again, I'm 38 years old. This goal is Like I'm talking about 30 years from now. I need 40,000 a year for 30 years after that. Okay, this is the reality, and this is some of the harsh realities. I need 40,000 a year for 30. I need 30 years. I need 40,000 a year for 30 years. That's just the reality of it. That's going to happen. I need it 30 years from now. Let's pretend I have 100,000 savings. I'm still going to need $1,500 a month. Okay, and just a quick note, this 40,000 is in today's dollars index. So there's what's called inflation. Inflation means that your money is worth less. 40,000 a year in 30 years from now is not going to be the same. It's going to require significantly more. And that assumes that I have a 5% investment return as well. In order to reach this $1,500 a month, I need a 5% investment return. Now, here I only have 1,000 can save. This gets into priorities. What are important to me? So all of these time cost savings for each one of these goals, nothing is set in stone. And if I only have $1,000, something is going to have to give here. I may either have to change one of these goals. Maybe my bathroom reno has to be in 2 years instead of 1 year. Maybe I have to do a smaller renovation. Maybe my kids need to consider, maybe I need to pay much less for my children. Or maybe I have to work longer or consider a much more modest retirement. Maybe something's basically got to give here. So that gets into priorities. A, which of these goals are my priority? And B, is it more important for my bathroom? Is it more important for my kids? Is it more important for, maybe I have to push these things off. So each one, and everybody's different on that. An example of that, for my kids' education, the time, I can't change that time. They're going to be going to school in 10 years from now. I can't stop that clock. But my retirement, maybe I can. My savings, maybe I can allocate a little bit less to that. Maybe I have to be a bit more modest in what I accomplish for them. So those are basically the things in my life. Some of those points are variable and some of them are fixed. It all depends on what my priorities are. If it's important that my bathroom is done in 1 year, if that's extremely important to me, then everything else has to fall in line in order to achieve that. And maybe I have to cut back somewhere else. Any business administration students like I was, economics 101, economics is the study of trade-offs in order to achieve one and what is more important. So here's another example. Okay, now that I'm working, now that I've graduated, I earn $50,000 a year. There's taxes that come into play here. In Ontario, that's actually going to cost me almost $11,000 of taxes and CPP and EI and all of that. I'm only taking home $39,000. That leaves me $1,500 every 2 weeks. Once I deal with rent, car payments, insurance, house savings, so this is kind of goal. I'll kind of put these goals up here real quick. So this might be something more in line for you. Obviously, you guys are in a different situation than I am. Maybe one of them for you might be I want to buy a car. So here's an example. I have $5,000 down already, plus a $15,000 car loan. I need to save $5,000. I've got 1 year. I'm going to need $192 every 2 weeks in order to do this. Later on, that car loan, though, that $15,000 car loan is now I got to pay $130 every 2 weeks for that loan. That may impact my ability to save for other goals. I'll also have to pay for gas and car insurance as well. Okay. And what about needs and wants? A car is I won't say that it's a want and not a need, but a car is one of the biggest killers financially. Okay. It's what we call a depreciating asset. Okay. You can buy this car for $20,000. If it's brand new, the day you move it off the lot, it's worth $15,000 and not 20. I'm going to pump money into this thing for the next 5 years or however long it shows here. And then by the time I'm done, in 10 years from now, that car is going to be worth almost nothing. That's called the depreciating asset. Basically, I bought it, it's worth a lot today, but as time goes on and the more money I put into it, the less money it's actually worth by the time it's done. It's kind of like a cell phone. An iPhone 5 or whatever may have cost $800 a couple of years ago. Now it's certainly not going to cost $800 now. It's not worth more. It's worth less today. Buy a home. This is actually the other way. This is an appreciating asset. This is something that has historically gone up in value. So I want to save for a down payment, cost $20,000. I want it in 1 year, or I want to do that in 3 years. I'm going to have to save $252 every 2 weeks to be able to do it. If I move that time frame to 5 years instead of 3 years, it costs me about $155 every 2 weeks instead. Now that gets to the problem. I only have so much money to go around. What is important to you and what is important to me? Which one of those three variables, which one of those two goals, which one of those three variables for each of those goals is important? Okay, this gets to wants versus needs. So I mentioned earlier, and this very much impacts a budget. So again, as mentioned, I like fancy suits. This one here starts at about $729. By the time it's done, it'll probably be closer to $1,000. This one here, $201. They're basically the same. Okay. I attach an importance to the first one. Whatever, that's my problem. Okay. Very similar. Apple EarPods. I don't know how many people have these things. You know, for me, the first one is silly, or the first one is important. The second one is silly. Someone else listening to this, you're probably thinking the opposite. Maybe these earbuds are important to me versus the suit. However, you can also buy these Aero buds. They look identical. You wouldn't, from the outside, you wouldn't tell the difference. They're $17 at Canadian Tire. I took this picture a few days ago in anticipation of this. I saw these and had to throw it in there. They're $17. They're identical. It's very similar to this suit. Someone on the outside couldn't tell the difference. The person wearing it probably couldn't tell the difference. They do all the same thing. It's they're earphones. You know, you can put up all this fancy stuff in there, but it's effectively the same product. So again, this, your wants versus your needs, the difference between one and the other. Well, one of them I've saved $500 in the suit, and I can use that to maybe put towards a car payment, put towards another goal of mine. In the case of these earbuds, the same type of thing. You know, you can save. This person with the AirPods Pro, you can save $300 and go use that for something that may be more important just by buying these Aero buds. So again, that's just a perfect example of wants versus needs. Okay, now goal setting with MyAdvisor. So this gets into a program more live example of what it actually looks like when we put it together. So here are two of my goals up top here. So education, I mentioned. I want to provide $5,000 a year for 4 years for 2 of my kids, and by the year 2029. Okay, I'm actually significantly above that. If I continue saving the way I am, we're closer to 20 grand a year. But that's neither here nor there. Same thing I need for retirement. I've said that I need $6,500 a month at age 65 after taxes. I'm well exceeding that goal. Okay, this is kind of what this looks like. Now, in order to do that, here is, again, I've got 2 RESPs for my kids. I'm saving $200, $208 a month into them in order, it's basically $2,500 a year per child. And I have an aggressive growth type of investment portfolio. I didn't achieve these numbers here that I'm showing in those balances by being safe and cautious with my money. Aggressively investing and doing so. So I've actually significantly exceeded my goal. I'll probably wind up using that money. My wife and I have had discussions. We'll probably give it to them for a down payment on a house to, we'll match whatever down payment they have. So this gets into, below here gets into some of the details of that goal. One is going to start in 2029, the other 2032. There's their birthdays, and here's kind of what we estimated. So that just gives kind of a much more live version of those of goal setting. Okay, and that's just kind of an idea of financial planning, what it is and how it works. Now, as far as examples for you guys, by actually setting those things, you are much more able to actually achieve those goals. 90% of achieving a goal is just writing it down. And that's an example right there. That program, if there is a deficiency and if I needed to save more, then I know what I have to do, okay? It's one thing just to save money willy-nilly. It's one thing to, and I liken it to going down a path. If you're going down a path, you have no idea where you are or where you're actually going, then you're going to have much different feelings. Whereas if you're going down a path, you know the end result, you know where you're going to get, you know the way of that path. I know that I have to put one step one foot in front of the other, it's much easier. Okay. An example to buying a house. For many years, I helped people save to buy a house. Students who had just come out of school, I want to buy a house in 5 years. There are two ways I can go about that. I can say, well, come back with $20,000 for a down payment. The other way I can say is, look, if you want to do it in 5 years, save $155 every 2 weeks. It's the same thing at the end of the day, but one is much more achievable. If I told them just come back and put away $155 every 2 weeks, come back in 5 years, it's a much more achievable, even though it's exactly the same thing. Whereas if I told them come back in 5 years with 20 grand, it's much more difficult. It's, the journey of 1,000 miles begins with the first step, and it's the same thing. My wife runs. She likes to run. She did a half marathon last year. She didn't look at the end. She looked at the end result, but the way that she achieved it is 1 kilometer at a time. She focused on each kilometer, and by the time she was done, she had finished the race. Good on her, fantastic on her. But the entire time, she was just focusing on 1 kilometer at a time. So that's how financial planning works, and that's basically the idea, is to take a large goal, break it down into bite-sized chunks. How can I get there, and what's the most effective way? So that's basically how that works. Now, I put up some contact information. There is my own information. I've also put up the contact information for Prerna. She's one of my banking advisors I work with. She is also a recent graduate of Algonquin. Feel free to absolutely contact me or contact her. If you have any banking needs, ask her. If you have any financial planning needs, I can certainly help with that as well. So there is my information in Prerna's as well.
So
thank you. That's the end of it there. Thank you very much. I'm certainly open to questions or whatever have you.
Yeah, that was great. Thank you, Chris. And very good points about writing down your goals. I find like that really helps. We did actually have a question come in. Someone emailed me the question. So it is from Mizuki. I'm not sure online at the moment. And she says, I would like to be advised on how to grow money in my savings account. I have $10K and I will not use this money for 1 to 2 years. Instead of putting the $10K in savings, I'd like my money to grow. So I'm looking for safe ways, not high yield.
Okay. On that, as far as that's concerned, so if the primary part of that is a financial planning. Okay, so again, number one is to identify, first of all, kind of what I had mentioned there. Identify what am I actually saving that money for? First of all, like what do I want to accomplish with that? Is it buy a house, buy a car? Is it an emergency fund? That's the first step. If you can identify that, it makes it much easier for us to give advice on that. As far as 1 to 2 years, you're not actually going to find too much out there just due to that amount of time frame. If it's saving for an identified purpose or for a short time frame, and trying to grow it, is that in order to grow it, you need to take some risk. Okay, I had mentioned earlier my RESPs have grown significantly. Same with RSPs, all of that. But I had done so, and there have been points I've lost significant amounts of money doing so along the way. COVID wasn't friendly for investment accounts. It has been now over the past month, but back in March it wasn't. So because of that, you're very limited to the options that you can use. Number one is you can do a savings account. Right now, interest rates are extremely low. They're always going to be low in savings account relative to other things. Back many years ago when I had graduated, savings accounts were paying 5%. Now they're not. But that was considered back then, that was considered a low rate back then. Now it's a fantastic rate. So number one, you can do what's called a savings account. Number two, the other option is a GIC, a guaranteed. We lock it up anywhere from 1 to 5 years. Not in all cases, but in most cases, you can't touch it during that period of time. And we give you a slightly better interest rate. It's not going to be much better, but it will be better than just leaving it in a savings account. At this moment in time, RBC, we have several options. So do different banks there. Right now, we're paying about 1.3% for 1 year and 1.25% for unlocked. For it would be accessible if you need it for 1 year as well. So there are some options there, but you are somewhat limited to that. Another one to do is to consider there are what's called tax-free savings accounts. There are various options as far as how to put that in and not have to pay taxes on that. So that would be something a little bit more tactical financial planning that it would be best to kind of assess those goals first.
Awesome. Thank you, Chris. Another question came in through the chat. Should I make a monthly budget? Some expenses are bi-monthly, like water, and some are bi-weekly. What's the best way to tackle those outlier payments?
Oh, sorry, can you say that? You cut out a little bit there.
Yeah. Okay. So the question's in the chat. Should I make a monthly budget? Some expenses are bi-monthly, like water, and some are bi-weekly, like a mortgage. What's the best way to tackle those outlier payments?
That's a good one. I particularly like flowing with what your payment schedule is. If you're paid every 2 weeks, then do it every 2 weeks. The other one to do is that you can do it monthly, but what you can do, if you're paid every 2 weeks, take that payment. Basically, there's 26 biweekly payments in a year. What you can do is say, if you make 200 payments, if you make, say, $500 after taxes every 2 weeks, take that 500, times it by 26, and then divide that by 12. And that will show basically what your monthly budget is. So there's two ways. I like saving. For savings, I usually suggest if you want to put away an automatic transfer, do it on your payday. $50 a pay, whatever it is, be it $50 or $1,000 a pay, that's up to you. Whatever you're basically able to do your savings on your payday, and then do your budget as far as a monthly one. I find that that's easier and more effective.
Awesome, thank you. If anyone has any questions, you can just add them to the chat or raise your hand. And if there's nothing else, I do recognize it's almost 11.
I do have a question, sorry.
Oh, sorry, go ahead.
Yeah, thanks for the presentation, Chris. My question is essentially, like when I was working, obviously I had a little bit of money coming in, so that helped. But now where I'm not working, it's a little bit different. So I had managed to, I have a TFSA, and I had managed to save some money through some equities. But my issue is that I have two credit cards. One of them has a high balance, but a low interest rate. The other one has low balance, high interest rate. So I'm at a point where I have enough funds to cover off the full balance of the low balance card.
Can you say that again? Sorry, the internet's cut off a bit.
Oh yeah, sure. So I have two cards.
Yeah. So you're at a point where okay.
Can you hear me now? Yeah, where I could pay off the full the low balance one in full, but then I also have the high balance one, which has a lower interest rate. So I'm trying to figure out what would be best to do: cover off the full balance of the low balance, or should I concentrate on the one that has the high balance instead?
Always concentrate on the one with the higher interest rate.
Okay.
Absolutely, take care of that one first. Yeah, start with the higher interest rate one. Get that down as much as possible and pay it off, and then work on the other one. Always start at your highest interest rate first, and credit cards in particular.
Yeah.
Okay. A note on credit cards and credit facilities. Line of credit and credit cards, they're not really meant to be paid off. Okay, whoever invented those didn't do us any favors. For me, my wife and I, we have credit cards. She actually uses a copy. She has a copy because we get points, and then I pay it off every 2 weeks. However, for you guys, and for anyone to note, credit cards are not meant to be paid off. That's why you don't do, anything that says, you can borrow $5,000, but you only have to pay back, say, $100 a month. Not actually meant to be paid off. It's meant for you to basically pay interest. That's why they don't do car payments, right? As I mentioned, they don't put that on but the car dealership's not giving me a revolving credit card because I'll owe $20,000 forever on that, but my car will be worth zero. So always start with the highest interest stuff, get that paid off first, okay? And particularly if you're investing money with a high interest credit card and you have a balance, don't do that, because the high interest, you're guaranteed to pay that high interest amount, but you're not guaranteed those returns on your equities. You know, you have to take risk to make 20% you have to take a lot of risk to make 20% in the stock market, but 20% is guaranteed, or even 12% on a lower interest one. It's guaranteed on a credit card. So get those paid off first.
Awesome. Thank you.
You're welcome.
Okay, I think that's it. No other questions have come in. So we'll just wrap up. I just want to say thank you so much, Chris, for joining us. And your wife is also, she's alumni too, right? You said Algonquin.
Thank you. Thank you. I'm glad to help, and very glad to give back. Indeed, I hope financial success to everyone here. The earlier that you can do this stuff and get a jump on it, it's much better to have a head start on this sort of.
Thank you. And thank you everyone for joining. We do have more.
Thank you. And I appreciate your time today.
Thank you.
Sorry, what was that?
I was just saying we do have more upcoming virtual events. So our next one is tomorrow. Leanne will add the link in the chat. Thank you, Leanne. So it's home gardening tips, and it's from 2 to 3 p.m. tomorrow. All the details are online there. Thank you so much, Chris, and thanks everyone for joining. See you.
Thank you. Have a good day.
Bye.